Hello, everyone, and welcome back. Today, we will talk about a very, very important risk class, which is the interest rate risk in trading book. And as we discussed briefly before, the credit spread risk is also sort of like a cousin to the interest rate risk. So today's topic is GIRR, that stands for General Interest Rate Risk, and CSR, Credit Spread Risk. General Interest Rate Risk, okay. Now, we understand the interest rate risk, right? So basically, you have a risk-free yield curve. Every interest rate instrument, as in any cash flow that happens in future, we have to discount it back to today to calculate the present value, which is the price of the instrument, right? So pretty much practically in all instruments, you will find the interest rate. If there are cash flows promised in future, you have to discount them. For discounting, you need to use interest rate. If the interest rate changes, your PV changes, hence the price changes. So that's how interest rate risk drives the changes in the prices of the instruments and hence the value of your portfolio. Okay, Vishal has a question under CSR. Are we covering securitized, non-securitized? Yeah, so far I have not actually talked about the securitized portfolio. So we have two flavors of it. One is called correlation trading portfolio. The other one is non-correlation trading portfolio. These two fall under securitized products. I have deliberately not discussed this because the underlying mechanics of we have to understand how securitization works so that we understand attachment point, detachment point, how the calculations are done. So we'll cover that later. For now, we are only focusing on non-securitized products. Okay. All right. Good that you brought it up. Okay. So yeah, so that's basically sort of the introduction to GIRR, and CSR refers to credit spread risk. When we deal with risky bonds, like corporate bonds, which are not default free, then we discount their cash flows using a higher sort of yield curve, right? Because if the securities are defaultable, they will give you a higher yield. Otherwise, why would you buy it, right? So that corporate yield or a risky yield is a combination of general interest rate plus some credit spread. So CSR captures the variation in that spread. So this is sort of, it captures the migration risk, you can say. Rating migration or changes in the creditworthiness of the issuer, migration risk of the issuer. This is all in trading book right now, okay? This is in trading book. We have already talked about the default risk of the issuer, and that is captured separately under JTD. Remember, JTD captures default risk or jump to default risk. CSR is more of a migration risk, okay? Change in credit spread. Okay, so that's the background. Now, today we'll talk about delta risk, all right? So there is Vega, we'll come to Vega later, and there is always curvature risk. Please remember that before, when we discuss curvature risk, like what are the instruments which are in scope for curvature risk, plain vanilla bonds are not part of curvature risk. As in coupon bonds, zero coupon bonds, they are not part of curvature risk because the cash flows can be written as a linear function of the notional. That was the definition. Although we know that delta approximation or the duration approximation of the bonds are not adequate, we do have a convexity term. But from a regulatory FRTB capitalization standpoint, bonds are exempt from curvature risk treatment. Okay, just because their cash flows So every month you get coupon. Coupon is a fixed percentage of the notional, right? Linear function of notional. There is no non-linearity there in terms of the payoff or the cash flow. So there is no curvature risk for plain vanilla bonds. However, if there are interest rate options, for example, caps, floors, or callable bonds, right? Or instruments with embedded optionality, those will be part of curvature risk. Okay. Rohit has a question, how to know which products are exempted? I have covered this in detail in the curvature risk introduction. Please go back and refer to that lecture. There is I have discussed which instruments are in scope. So if you have any doubts, let me know. All right, so let's discuss the maths, simple maths that drives the risk, and then we'll look at some examples in Excel. And then in the second half, I will walk you through the entire FRTB regulation, the calculations that we need to perform under GIRR and CSR. Okay. So first example, very simple. This is something we have already done before, but I don't want you. So this is all about practice, right? And you have seen the power of Taylor series and normal distribution, right? Although we don't know what distribution regulators have used, probably some returns, I mean, some distribution with fat tails, maybe, we don't know, but at least we can use normal distribution to appreciate the formulas. They'll be similar, okay? But so far I have introduced everything in terms of, first you write down the P&L equation, then using Taylor series, and there you naturally see the sensitivities in action, right? You don't have to remember 50,000 different formulas. So we are following the same set of steps every time, okay? All right, example number 1. So keeping things simple, we'll consider a flat term structure. Now this term structure modeling in itself is a very complicated area. Actually, it's not that easy. There are a lot of term structure models. We will discuss the term structure models when we talk about counterparty credit risk. There we have to do lots of exposure modeling using Monte Carlo simulation. So there the term structure models will be handy. So we'll discuss it there. For now, assume simple term structure. We are not doing any modeling of term structure. It is given. Okay, flat term structure. What does it mean? It means that so term structure is also called as yield curve. On the y-axis, you have yield. On the x-axis, you have tenor or maturity. So if there is a payment happening in future, right, then you will discount that using an interest rate. Depending on the tenor, you could have different rates, right? For now, we're assuming the term structure is flat. That means it is a maturity agnostic. It is same everywhere. Sorry, let me try to draw a parallel line. Oops. This is weird. Okay. All right. So let's say this is R is equal to, let's say, 5% for now. Okay. That means for every maturity, so 6 months, 1 year, 1.5 years, it's the same rate. Okay. Flat term structure. This is a theoretical, just I mean, toy example. In real life, you don't have flat term structure. We'll go there, but slowly and steadily. Okay. Now let's quickly. So I'm going to speed up because we have done this before. We have a very simple bond. We are standing at time 0 at 0.5. The bond is, say, the bond has a principal of P. P is the face value. Okay. And it gives semi-annual coupon of C% of the notional or P, correct? And let's assume continuous Compounding. Continuous compounding makes the math easier. Continuous compounding yield curve. You can always go back and forth between continuous compounding and discrete compounding. I hope you know the formula, how to. If you don't know the formula, it's very simple to derive it. So just in case if you don't know it, if you're standing at time 0, if you invest your money for 1 year in a continuous compounding interest rate, which is, let's say, RC, C stands for continuous, how much money you will have at the end? E to the power RC times 1. That's the money you'll have, right? If you alternatively, if you want to find an equivalent amount, equivalent interest rate in terms of discrete compounding, which compounds, so let's call it RM. M is basically your compounding frequency. Right? So if M is equal to 2, it means semi-annual compounding. If M equal to 4, it means quarterly compounding, like that. So how much money you'll have at the end? It will be 1 plus RM divided by M. There will be M periods in a year, whole to the power M. So this must be equal to this. And there you have the relation between RC and RM. You can always go back and forth between continuous compounding versus discrete compounding. So that is always there. Okay, so it's a 1-year bond. It pays coupon C%, which is semi-annual. And then we have a continuous yield curve that we will use to discount the cash flows. The first cash flow is simply PC by 2. Is it correct? Notional times. All the rates are always expressed in annualized fashion. Irrespective of the type of or frequency of compounding, everything is always annualized. So C% is a annualized version. So if it's a semi-annual coupon, then you get half, C by 2. What is the cash flow here? Can somebody tell me quickly? P plus PC by 2. Perfect. Principal plus the coupon. Right? All right. Now, so what is the value of the bond? B is equal to PC by 2 e to the power minus 0.5 R plus P plus PC by 2 e to the power minus 0.5 into, not 0.5, 1 times R. Okay. Now, dB by dr, because we want to find out the rate of change of the value of the bond if the interest rate changes, right? So we need d by dr. I'm just doing it one more time. I think we have done this before, but you must do this, okay, on your own. Otherwise, you'll never feel confident. PC by 2 is constant. E to the power something derivative is the same, times derivative of minus 0.5 times R with respect to R is minus 0.5 plus P plus PC by 2 e to the power minus 1 into R times derivative of minus 1 times R with respect to R is minus 1. Now I'm going to divide the bond value here on the left hand side, also on the right hand side. There is minus in both these terms. So let me take minus outside. I get PC by 2 e to the power minus 0.5 R divided by B plus P plus PC by 2 e to the power minus 1 times R divided by B. Okay. Do you recognize some of the terms? Did I miss something? Oh, yeah. Thanks. I missed a couple of things actually. So let me into 0.5 plus this into 1. Okay, thanks. this part is the PV of first cash flow, right? This is the CF, and the into e to the power minus 0.5R is PV of CF1, correct? This is the time of first cash flow. Okay, this is the PV of second cash flow, and 1 is the time T2, time of the second cash flow. This whole thing this part, what is B actually? B is the PV of all the cash flows, CFs, all the cash flows, correct? That's the price of the instrument. So essentially, you're looking at a weighted average of time of each cash flow. You're taking time of each cash flow, and then you're taking a weighted average. What are the weights? Weights are nothing but how much cash, what is the PV of the cash flow you're getting at that time, divided by total PV. That's the weight. Ultimately, all these PVs will add up to B, right? That's the value of the bond. So how much weight you're giving to the first time, that's the PV of cash flow 1 divided by bond price. Second one is PV of cash flow 2 divided by bond price. That's the weight times the actual time when the cash flow is happening. The weighted average of time. What is this called as, guys? It's nothing new. What is this called? This is equal to minus duration. Yes, D. D is called as duration. To be more extensive, it's called as Macaulay duration. All right. And that's it. So it's just the whole expression reduced to a single number, right? D. That's good. So we have dB by dr equal to minus B times D. D is just a number. It basically, it's the number of years. So, if it's a 1 year bond, you'll find D as, let's say, 0.7, 0.8, something like that. And then dB by dr, you take B to the other side. B is the price of the bond, right? So this is dollar value. So this guy is called as dollar duration. You'll find some inconsistencies in these different definitions, but as long as we get the maths accurate, that should be fine. This is dollar duration because we are multiplying a price, B times D. All right. Now you would be surprised, sir, why we have heard that the price of the bond, the price yield relationship is linked to modified duration. But here it's coming as plain duration. And the reason is we are using continuous compounding. So when you are using continuous compounding, the Macaulay duration is actually equal to the modified duration. We have discussed this before. I'm just doing a recap. Same. All right. If you have a continuous compounding, not continuous, if you have a discrete compounding case, then if D is the duration, your modified duration. So if this is the duration, just remember this, okay? Modified duration would be D divided by 1 plus R by M. M is the compounding frequency, modified duration. R by M. And you can see if M tends to infinity, this becomes D, right? So that's continuous compounding. All right, so this is our equation of interest, because we want a relationship between change in bond price and change in interest rate. That's what we've been doing so far in this course, right? Now let's do a Taylor series approximation, first order. Taylor series approximation, first order. That means we are only considering delta, no gamma or anything. Please remember When we write D, right, D means this relationship holds good if the changes are infinitesimal. Infinitesimal changes are theoretical ideas. They do not exist, but it makes the math easier. I mean, I could easily differentiate and come up with this equation. If everything is continuous, you can always differentiate. I mean, there are also continuous functions which are not differentiable, but anyways, so we could arrive at this equation easily, but this equation is valid when the changes are very, very unimaginably small. Only then this equation is valid. In real life, we don't deal with infinitesimal changes. We deal with finite changes, sometimes small, sometimes substantial, but much bigger than infinitesimal. That's where Taylor series comes into picture. So for D becomes del. When we say delta, it means finite difference. Okay, D is differential, delta is finite difference. Okay, so delta B, this is what we have been doing so far. Delta B is derivative times delta R. Okay, this is the sensitivity, and then change in R will lead to change in B. That's all. So I can write this as minus B times D delta R. Okay, and this would be some dollar value. $200, $150, something like that. Now, what do I do with this? There is a concept called as PV01 or DV01. Either I prefer PV01, but up to you. What is the definition of PV01? What is the definition of PV01? 1 basis point change to price. Yeah, correct. How much the value of the bond will change if the interest rate changes by 1 basis point. Okay, so essentially this is how much is del B if delta R is 0.0001. That's 1 basis point. How do you remember how many zeros? The easiest way to remember is 1 basis point is 1% of 1%. 1% of 1%. That is 1 basis point. All right. So using this equation, how can we find out PV? So question is, let me write it here. If delta R is equal to 1 basis point, what is delta B? Simple. We have the equation delta B is equal to minus B times D times 0.0001. That's the change. Approximate change in bond price, linear approximation, if the interest rate changes by 1 basis point. Next question, if interest rate changes by 5 basis points, then what is delta B? Essentially, what you want to do is this: delta B is equal to minus BD times 0.0005. Okay. Now, here is the thing. There is a little bit of ambiguity in how we do, how we define things. To me, this is PV01, this whole thing. Which will tell you exactly a dollar value. Say for 1 basis point change in interest rate, the change in value of the bond is $10. That is, to me, that is PV01. If you have PV01 handy, so let's say if this is, say for example, this is $10. Actually, this would not be 10, it will be minus 10. Because there is a minus sign. And we know for a fact that if interest, so basically if interest rate goes up, bond price goes down. If it is a long position. All right. If it is a short position, it will be opposite. We know this. Using this information, I can calculate this. So for 1 basis point, if the change is $10, for 5 basis point, what will be the change? For 1 basis point, if the bond price changes by $10. Question is, if interest rate actually changes by 5 basis points, then how much will be the change in bond value, assuming the linear approximation is still valid? 50, right? Straightforward. $50 minus $50. Okay, so here is the thing. If you define PV01 as this, so BD times 0.0001, next time when somebody asks you the change in bond value for a given change in interest rate in terms of basis points, all you need to do is multiply that 5 with this. Just multiply 5. That should be good enough. But in FRTB, the definition of PV01 is not this. The definition of PV01 is just the slope. I used a different ink. This is PV01 as per FRTB definition. That's fine. I mean, if you define this as FRTB, define this as the PV01, my calculations will change, but the answer will be the same. So going forward, when we say PV01, I mean, in FRTB at least, we mean minus BD. All right. Minus BD, which will be a big value actually, because you are multiplying the value of the bond into and duration. Okay, that will be a big value. That is not the change in value of the bond price if the interest rate changes by 1 basis point. No, you have to still multiply 0.0001 to get that change. Basically, PV01, the way Basel defined is, this is actually delta B divided by 0.0001. Just look at this equation. PV01 is delta B divided by 0.0001, which is, if you look at our equation, this is actually dV by dr. Pure slope. As per FRTB, the definition of PV01 is just a sensitivity, exactly how you define sensitivity, right? Change in value of the instrument by change in risk factor. That's it. This is a slope. So we will use this definition of PV01. Now, the only thing is, if you want to calculate delta B, you need to do PV01 times, say, for 5 basis points. You won't multiply 5, you will multiply 0.0005. Because this. That's all. Take a minute to digest this and let me know if you have any questions. So these are the questions. But our bond price changes each time after 0.001 change. So do we need to recalculate duration 5 times? No, exactly. So bond price with respect to interest rate has a nonlinear relationship. You need to capture convexity. However, there are 2 things. The linear, I said the linear equation still holds. Okay, so no need to worry about convexity and all. But you are right in the context that every time you have to recalculate the duration. Not 5 times, not 5 times in this case. If it is a 5 basis point jump, simply use the duration or the PV01 times 0.0005. That will give you the answer. But this PV01 itself, right, that depends on the current term structure. Tomorrow, the PV01 will be different. Day after tomorrow, the PV01 will be different because your maturity is changing, interest rates are changing. So every day when you want to calculate delta B, it should be take the fresh sensitivity from the front desk, which depends on the current dynamics, current residual maturity, current interest rate. But for delta B calculation, no, you don't have to calculate 5 times. It's just one simple equation. But this will ignore higher order terms. This is just an approximation. Okay, PV01 is calculated daily. It will change, right, from time to time. Good. Any other question? Clear, everyone? Okay. All right. Next step is to use this equation, linear equation, to calculate what? Value at risk. That is what we have been doing. That is what you need to do in market risk. Value at risk. So we have this magical equation, right? Delta V is equal to minus BD delta R. Remember, I'm still operating under continuous yield, continuous compounding. Accordingly, if you have discrete, your equations will change. Now, how do I calculate value at risk? Parametric form. Well, this is delta R, and this will be delta V. Normal distribution being scaled by a sensitivity, a scalar, simple constant sensitivity, will generate another normal distribution. All right. But the thing is, there is a minus sign here, right? So for a long position, it scales by minus BD, right? So negative. That means if you're looking at a worst case loss scenario for your bond portfolio or single bond, here it is a single bond, we are looking at a up move in interest rate that will result in a loss on the bond portfolio. Okay. So if this guy is normally distributed with mean zero variance, sigma square LH. Okay. What is sigma? Sigma is daily variance. You multiply with appropriate liquidity horizon, right? Regulators have given it, so we don't have to worry. Yeah, so this will lead to a normal distribution in delta B, which is mean will be 0. Variance will just be scaled. So it will be what? B square, D square, sigma square, LH, liquidity horizon. This sigma, you understood this part, right? We have been doing this for, I don't know how many times now, but this is the equation, straightforward. So sigma of delta B is B D sigma LH square root. Sigma is sigma of delta R. That is very, very important. I see a lot of the students get confused with when to use R, when to use delta R. All right, that is very important. So remember, when we are saying delta R, what is delta R? Delta R is actually your absolute change, absolute rate changes. Absolute rate changes. What does it mean? You look at the interest rate daily time series. Okay. Take the time series of interest rate, daily time series of the interest rate every day. It will be changing, not as stock price, it will be changing little bit. Right? And then you take the difference, daily difference, that's the delta R. The sigma delta R that we are talking about is the volatility of daily difference of interest rates, daily difference of interest rate. It is not a relative thing. It is you take the absolute return and then take the changes. Okay. Don't get confused by the word absolute. It's not taking modulus or anything. It is the interest rate as is. You take that and take the difference. Okay, that's delta R. And sigma delta R is the volatility of this. Sigma delta R is the volatility of rate changes. Why I use the word absolute is because it is not relative. Normally, when we do value at risk for a stock, so recap, stock position, our fundamental equation is this: delta S by S is R, but here R is returns. It is not absolute change in stock price. It is a relative change. Relative. This is not absolute. It's a relative measure. When we say absolute changes means you take interest rate as is. Today it is 2.3%. Tomorrow it is 2.2%. Change is minus 0.1%. That is it. Don't do 2.1% minus 2.3% divided by 2.3. No, that's we don't want that. Nowhere in our equation we did that kind of a calculation. Okay. So here we used to do delta S is equal to S times R. S becomes the sensitivity. And when we define the distribution, it is for the returns. That gives the distribution for change in stock price. This is just a scalar. Here the scalar is this B times D. Did you understand the difference between this, when to use R, when to use delta R? Delta R is in the bond context, which means changes, you're modeling changes in interest rate. You want that time series, take the volatility. In case of stock price, you take the stock price time series, calculate the arithmetic returns every day. Then from the arithmetic return time series, find the volatility sigma. That goes into VAR calculation. In case of bond, it is the sigma of the daily rate changes. Simple change, not relative, absolute changes. Any questions on this? This is very, very simple, but very important. People get confused all the time. Sarada says, why did you say long minus BD? What does it mean? Yeah, I mean, bond and interest rate have a negative relationship, right? If interest rate goes up, bond price goes down, simply because there is a negative sign. But only if you are long on the bond. So if you have a long position, up movement in interest rate, so a big, large upward movement in interest rate will cause a big, large downward movement in bond price or bond value. So if you are long, your sensitivity is negative. If you are short, your sensitivity will be positive. You want the bond price to, I mean, interest rates to go up, so bond price will go down and you will benefit from that. Make sense? Did I answer your question? This is the sensitivity for a long position, negative, which we know, right? The inverse relationship between bond price and yield. But that's for a long position. So minus BD is the sensitivity. Okay, any other question? Clear, everyone? Okay, let's look at a quick example in Excel. All right, so we have face value 1, 2, 3, 1 million, 1 year maturity, semi-annual coupon at 4%, continuously compounded flat term structure 5%. This is the discounting curve, okay? 5% everywhere. The first cash flow tenor is 0.5, right? The first cash flow is just a coupon, which is notional times coupon rate divided by 2. Okay, straightforward. Second cash flow is the principal, the face value plus face value times the second coupon. This is the cash flow structure. Discounting discount factor is e to the power minus the tenor times yield is constant, so you take 5% everywhere. Just multiply the tenor, e to the power minus 5% times 0.5. This is e to the power minus 5% times 1. That's the discounting factor. Present value of the cash flow, this times this. And for this times this, that's the present value. Add these two present values, get the bond price. Okay. That's all. That's what we know already. Now, from here, how do we calculate duration? Duration by the standard definition would be you weight these times. Duration means average waiting time to receive all the cash flows. Some cash flow, this is the cash flow you received after 6 months. This is the cash flow you received after 1 year. So on an average, when did you receive all the cash flows? Simple, 0.5 times this plus 1 times this divided by total cash flow is this. That's what I've done. Sum product of these two divided by the bond price. That's 0.99, which is very, very close to 1. The reason being, look at these two cash flows. I mean, this is nothing compared to this, right? So majority of the weight goes to 1. So that's why you get 0.99. This is just a pure number, okay? Doesn't have any dollar significance in this. This is just 0.99 years. It's just a number. Now we calculate PV01. For PV01, the definition that we are using is just the slope, dV by dr. So let me show you so that we don't. We are using this definition, right? PV01 as per FRTB is just minus BD, which is same as delta B divided by 0.0001. That's the definition we are using. So minus BD is simply this. We know the duration, we know the bond price, minus BD is this. This is 0.98 million. Is this, so let me ask you this, is this the dollar change in the bond value if the interest rate changes by 1 basis point? So how do you find it? So my question is, if delta R, if interest rate changes by 1 basis point, what is change in bond value? How would you calculate? BD times 0.001. Perfect. Exactly. So go back to the equation. Simple. We calculated BD. This is the PV01 as per FRTB, and which is simply the dB by dr actually. That's minus BD. For PV01, you have to multiply the delta R. dB by dr times delta R will give you dB. The question asks what is dB, change in value of the bond. So multiply 0.001, that will give you the answer. So this times 0.1. $98. $98 will be the change in the bond value if the interest rate goes up by 1 basis point. Straightforward. If I ask you what will be the change if it is 5 basis points, okay, what I can do is multiply this by 5 or multiply this by 0.0005. Okay, that's all I wanted to tell you. Okay, now we arrived at PV01 using an analytical expression, using derivatives, right? This is exact. Most often than not, in practice, we use something called as delta approximation, using finite difference. Okay. In fact, for all the sensitivity calculations, Basel has recommended the definition that you see in FRTB is a forward delta, as in you shock the risk factor by either 1 basis point or 1%. 1 basis point in case of interest rate, 1% in case of stock price commodity effects. Measure the change in value of the instrument, then take dB by dr or dV by dr, whatever, right? That slope. That's the definition of delta sensitivity as per FRTB. I did not do that because we will do it separately. We'll have a dedicated discussion on just sensitivities because in practice, you use lots of different advanced techniques. to minimize errors, because the moment you go to you start using delta sensitivities, obviously you're doing a linear approximation, but you can actually better that linear approximation by doing some kind of interpolation. If the changes are huge, right, then you can probably average out the sensitivity between current condition and future condition, something like that. So we'll take a look at those things. It will be a one dedicated class on sensitivities. But just as an experiment, let's do this. So this is the value of the bond, right? Let me store it here. Current value of the bond. Let me bump it up numerically a little bit. 1 basis point, 5.01. This is my new value. Okay. Now let me go back. New bond value, old bond value. What is the change in bond value? This minus this. Close to $98 that we found using. This is an analytical approximation. Both are approximation, linear approximation. The sensitivity was used from an analytical method. Okay, using derivatives. Here we are doing a numerical experiment. Okay, simply by shocking the underlier by 1%, 1 basis point. This is the change in bond value, which matches. If you want to calculate this PV01, you have to do dB by dr, right? This is the change in value of the bond for 1 basis point change in the interest rate. So by PV01 would be this divided by okay, that match is almost close, right? 98000. There are some differences. See, already there is some difference, right? But it's close. This is exact. This is a numerical approximation. All right. Any questions on this? More to come on this. What we did now is called a forward delta. Why forward? Because we increased the interest rate by 1 basis point, measured the change in bond price, and then we did a dB by dr, right? We can do the same using backward delta. Take the interest rate down by 1 basis point, measure the change in bond price, do a dB by dr. That will also be close to this. That is called backward delta. Even better is something called as center delta. That is more accurate. So more to come. So basically you do a forward shock, backward shock, then you use a different formula to approximate the delta. So we will have a dedicated discussion on sensitivities, how to find these deltas numerically. Okay. All right. So this is clear, right? Now we need to find value at risk. All right. So we have P, as per our equation, value at risk. This is PV01, right? That acts as the sensitivity. All we need is the sigma of delta R, and this is PV01 times sigma of delta R. Liquidity horizon has already been adjusted. I need to do one more step here. I didn't do it. Value at risk, 99%. N inverse, you can do 99% or 1%. If you do 1%, it will be negative, but we report value at risk as positive, so I can put a minus sign. Either way, it is symmetric, right? This is the deviate, and then sigma. Sigma is this BD times. Okay. That's what we need to do for value at risk. So if the annual volatility of the absolute rate changes, that means delta R is 1%. Why this percent is here? Is 1%. Then the 10-day value at risk could be PV01 times 1% sigma times liquidity horizon adjustment times the deviate. Okay. All right. PV01 sigma square root of LH, norm inverse. That gives me $4,559 loss. For 10 days, this is my worst case loss. So I need to keep this much buffer. But this is still where in theory, this is not FRTV yet, because in FRTV, there are a whole labyrinth of different calculations you need to do. So today, in the second half, we'll do that. You'll see one of the biggest routines that you need to follow to calculate, capitalize GIRR and CSR. Okay. All right. So this would ideally be, forget FRT for now. If I'm doing a VAR-based capitalization, this would be my regular capital for this particular bond, just one bond. All right. Okay. Let's proceed. Any doubts? Let's do one more experiment. And you would be surprised how easily it comes. You cannot be wrong, right? What if we have a foreign bond, as in a bond denominated in a foreign currency? What is the value at risk? Simple. Any P&L that we do, or even the value of any foreign instrument, right? Everything has to be converted to domestic currency, reporting currency. In your balance sheet, your assets, liabilities, everything, which basically is a snapshot of the values, right? Will be in the reporting currency. Okay. And then when you do P&L, that's the change statement, correct? To me, if you ask me, balance sheet is like the position of a particle, right? And income statement is the velocity, how fast you are moving, because income statement is per year, how much you earned in that year. That's the speed. It's a change statement, change in your earnings per 1 year. It's a speed, right? And then balance sheet is just taking a picture of what you have today. So where you are, that's the position. Anyways, so everything has to be converted to domestic currency if you have foreign assets. But what about value at risk? Value at risk basically is on the changes, right? It's not a snapshot on the values. It's a measure of worst case change. No worries. So we need to first write the equation for the value of the instrument. Value of a bond in domestic currency, right, is equal to value of that bond in foreign currency times exchange rate. This is true every second, right? Whatever is the value of the foreign bond in dollar, suppose there is an Indian bank, right? Whatever is the value of a foreign bond in terms of dollars multiplied by exchange rate, INR, how many INR per US dollar? So multiply 80. That's the valuation on your books in terms of domestic currency. After this, totally forget about finance. Once I want you to develop that, because see, maths is topic agnostic. Maths is maths. Don't tie maths to a particular subject or a topic. Once you have the equation, now it's a mathematical exercise. Only then you will be able to, become free. To me, this is Z is equal to X times Y. One variable, product of two other variables. That's all. Let me write it as V is equal to some X times Y. This value of the instrument is a product of two risk factors. Okay. Now, bond value itself is not the risk factor. Bond value is mapped to foreign bond value, would be mapped to the foreign interest rate. Correct? BF is a function of RF. All right. So essentially, your value of the bond in your balance sheet is a function of foreign interest rate RF, because this guy is a function of RF, and the prevailing spot exchange rate. Correct? Now let's do maths, just maths. This is one variable. These are two random variables, product, okay? If you are doing delta approximation, delta BD is equal to first order partial derivative with respect to RF, okay? Delta RF, first order partial derivative with respect to X, delta X. Any doubts in this equation? Taylor series, first order approximation. You have to conquer this equation. Otherwise, you'll always struggle in market risk. Okay, there are two. See, this is a bivariate function of two variables, RF and X. Both are changing. See, the value of the foreign bond can change tomorrow because RF can change. Value of, okay, and that drives the change in your value on the books. But the value on your books can also change even if RF did not change, but the exchange rate changed, X. That will also drive changes to your portfolio. So there are two risk factors, RF and X. And first order Taylor series approximation, first order sensitivity with respect to RF times delta RF, first order sensitivity with respect to X times delta X. I'm ignoring curvature and gamma and all those cross gamma other things, okay, for now. Okay, so now what is this sensitivity? You have to tell me what is delta BD by delta RF. Till now, I mean, let's not go to duration yet. Just look at this equation. I'm doing derivative of this term with respect to RF. Guys, give me 1 second. Okay, I'm back. Sorry about that. What's the derivative? This is a product, right? We are differentiating with respect to RF. Does X depend on RF? X does not depend on RF, right? So X will come out. This will be delta BF by delta RF. Delta RF. I have not done anything fancy. It's just a product of two things. I'm taking partial derivative with respect to RF. X will be treated as a constant. X will come out. Delta BF by delta RF. Delta RF. Plus, now I'm taking partial derivative with respect to X. So this will be constant, right? BF is constant because BF does not depend on X. BF is purely depends on RF. RF is held constant in the second term. BF times BF times delta BD. So this is BF, right? BF times delta X. Is this correct? BF is a constant, came out. Time derivative of this with respect to X is just BF. That's all. Happy with this? Any questions? Clear? Okay. Now this is X. What is this, guys? Del BF by del RF. This is our FRTB PV01, right? Minus BF times the duration, whatever it is. BD, remember? That's the FRTB, or you can say PV01 times delta RF plus BF times X delta X by X. And you know why we did that, right? We have been doing this. This stuff is common for commodity, FX, stock. We model the returns on commodity prices, returns on stock prices, return on FX rates. This essentially becomes a return on the FX rate. Okay, so when you take the foreign exchange rate time series and you want to calculate value at risk, use the relative returns, exactly how you do for a stock price, right? So treat the exchange rate as a stock price and do the calculation. So finally, this becomes X times PV01 delta RF plus BF times X. What is BF times X? That is what we had earlier, right? That is the value of the bond in domestic currency. Domestic currency times a return on exchange rate. And remember when we discussed, so now you can see clearly two different terms, right? But assume there is no correlation, actually correlation would be one. Okay, so in FRTB context, this is capitalized separately, this is capitalized separately. This would come under GIRR because the risk factor is delta RF, change in a risk-free yield. Okay, this component. And this component will be FX. And when we discuss FX charge, remember, we said that sensitivity for FX would always be the market value in a reporting currency. That is exactly what we have. Current value of the bond in domestic currency. That becomes the sensitivity for FX capital charge calculation. And the risk factor that you're modeling is actually not actually the return on FX rate. So return will have some distribution. Delta RF has some distribution. We are not modeling correlation between this and this. As per Basel, it is separate. So treat this as a separate risk class. This is a separate risk class. The capital charges will get added up. How naturally this came to being, see. And there is one more step. So to make matters very easy, when you are dealing with foreign assets, other than FX, right? If it is GIRR or equity charge, risk charge or commodity risk charge, just multiply the sensitivity with the current spot exchange rate. That will take care of the things. So now I can write this is PV01 dash. That's it. Now I'll forget about the spot rate. I don't need it anymore. I already, the current spot exchange rate, I multiply with the PV01 of the bond. That becomes a new kind of sensitivity and I will forget about it. I'll pretend this is my new sensitivity and life is good, right? And this is BD RX. Okay, so this undergoes FX. This is GIRR. Clear? What I want you to do is, I'll give this as a homework to you. Take a bond, domestic bond, a foreign bond, domestic equity, foreign equity, maybe one commodity. Take a domestic option and option denominated in a foreign currency. Take 5 or 6 instruments. Just do Taylor series. Delta approximation. Forget about curvature. Curvature is complicated, but we have seen the calculation. It's not that scary. And see how the equation naturally evolves. And then you will be able to identify each and every component and which risk class it belongs to. And you can isolate those components and capitalize individually. Just do this exercise. Okay. When you take options, the delta of option will come as the sensitivity. What else? For bond, it is BV01. For options, it is delta. For forward future, it is still 1. For stock, it is 1. Right? That's it. And X will naturally come. If you write it in this form, right? Every foreign instrument, you write it as market value of the instrument times the spot exchange rate. It will naturally come. So you'll end up multiplying the foreign exchange rate to the sensitivity of the foreign asset. That's the sensitivity. Okay, is it all clear? We have, I will show you an example where we have a foreign bond. and I'll show you how to do the calculation. But this is the power of following Taylor series systematically in market risk. So there's a question from RB. Why did you say that del RF and RX have correlation 1? Yeah, I said that because when you are adding capitals, right, separately, then you are not getting any diversification benefit. That will happen when you have correlation 1. It is not correlation 0, actually. It is correlation 1. To give you an example, what is the so this is stochastic, right? I mean, this is a scaled version of a random variable. This is also a scaled version of a random variable. So if we have two random variables, sigma, what is the, actually not, let's take variance. What is the variance of one random variable plus another random variable? Sigma x square, sigma y square, 2 rho sigma x sigma y. Okay. If rho is 1, this becomes sigma x plus sigma y whole square, and sigma of x plus y becomes sigma x plus sigma y. Value at risk of x plus y, the portfolio, is value at risk for x plus value at risk for y. Simply you're adding the capital charges. When correlation is 1, there is no diversification benefit. If you have 0 correlation, you actually get this sigma x square plus sigma y square square root. Now, that is my sigma x plus y. This, right? This is less than sigma x plus sigma y. Okay, because these are positive, and we are skipping this term. So you get some diversification benefit with correlation 0. But I'm saying if you add capital charges individually, then it's actually correlation is 1. Okay, just being conservative. Very, very FRTV in every step, right? You will always find some element of conservatism. Highly conservative. That's why the capital requirements has gone up a lot. Okay. All right. There is a question from Vishal, but value at risk is sub-additive. Value at risk is not sub-additive. Value at risk is probably the biggest flaw with value at risk. Value at risk does not satisfy sub-additivity. Expected shortfall does, yes. But see, I'm using value at risk to just to, connect the dots, and you'll be able to appreciate the formulas. But regulators probably are not using value at risk. See, for IMA, which is the advanced approach, we are using expected shortfall. So we'll talk about that when we do IMA. You can also calculate expected shortfall on analytically. So using from distributions. I mean, obviously don't use normal distribution. Maybe use a T distribution to accommodate fat tails, right? But still you can get analytical results. And probably regulators have used some kind of analytical expected shortfall, but the equations would be similar. Okay. So yeah, that's what it is. More to come on ES when we do IMA, not now. I'm doing value at risk because you know what, anyways you have to calculate value at risk for backtesting purpose. For backtesting purpose, you have to calculate value at risk. If you want IMA approval for the trading desk, then the desk has to pass profit and loss attribution test and backtesting. So more to come on that in when we discuss that. But so you have to calculate. So backtesting is done on value at risk measure, not expected shortfall. Okay. All right. Yeah, that's what I had for the first half. Let's take a break for 5 minutes, and then we'll discuss some more complicated. We'll introduce a little bit of complications one step at a time, and then we'll go through the regulatory guidelines. Okay, so let's meet after 5 minutes. Oh, there is a question, why VAR is not subjective? I will have a detailed dedicated lecture on that. We'll talk about coherent risk measures. So when we discuss IMA, what is coherent risk measure? How is expected shortfall superior to value at risk? What are the different properties of coherent measure? I'll show you examples in Excel and explain in detail. Yeah. So just hold on till that point. All right, let's meet after 5 minutes.